Hey guys, hope you're doing well out there. Today, taking a look at the Hershey's Company, ticker symbol HSY. This one is down nearly 20% year to date and down well over 30% from its all-time highs back in May. We'll jump into the high-level overview of this company, take a look at my reasons I think why this stock has fallen over 30% from its all-time highs, jump into the earnings, the valuations, the statement of income, the balance sheet, and share my fair value for this company. And then, as always, jump into the technicals. This one has posted 7 straight months of stock price declines, and we'll see if this one is ready to bottom out and where you can come in here and I think pick up some shares in Hershey's. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would mean a lot. Hershey's is a brand most of us probably know and love, and I certainly love their chocolates, but we're taking a look at if this company is investable today. This one does pay you a nearly 2.59% dividend yield and close to a $38 billion company. From a market cap perspective, you see on a 52-week range, this is right around its 52-week lows at just over $184 a share. Now, from its dividend perspective, it has grown its dividends over the last 5 years by an annual compound rate of over 10%, has increased its dividends over the last 14 years, and has a payout ratio close to 45%. So from a dividend perspective, this is known as one of your safety staple stocks from a dividend perspective. Now, I'm sure you know of the Hershey's milk chocolate and their staples, Hershey's Kisses, but this brand actually owns a ton of other companies, including other chocolates you might be familiar with, such as Kit Kat, Reese's, Twizzlers, Brookside, and they even include icebreakers, which are mints. They also have a ton of other snack foods on their brand. Apart from just their chocolate bars, they have lots of baking products in terms of semi-sweet chocolate chips, syrups, confectionery products, snack foods like popcorn and cereal. They have seasonal products such as Christmas candies, and then they also have beverages and international brands. So needless to say, this is a company with a ton of brands under its umbrella, similar to a lot of companies in this space. When you walk down your grocery store aisle, yeah, you're seeing a lot of names, but chances are a lot of these companies are owned under the same umbrella. And so you have giants like Mondelez, Nestle, Kellogg's, Mars, General Mills, PepsiCo, Unilever, and along with that, you have a giant like Hershey's that owns a ton of products in your grocery aisles. And so needless to say, although they own a ton of products, they do still have lots of competition from other companies in this area. There's a ton of consolidation within the space, and you have a ton of competition. And so that's something to keep in mind. There's always a fight for market share within this space. Now, I think one of the main reasons why this stock is down over 30% from its all-time highs back in May is because of the price of cocoa, which is the number one product used in making these chocolates and confectionery products. We pull up a 50-year chart of cocoa, and yeah, you see the price of cocoa is nearly at a 50-year high, trading at $4,200 per metric ton. You see over the past 1 year, the price of cocoa has skyrocketed nearly 65% over the past 1 year. And certainly that will affect the input costs over at companies like a Hershey's. And the reason why cocoa prices have skyrocketed is because there's a global deficit in cocoa beans stemming from major producers like the Ivory Coast and Ghana, which I think these two countries combine for nearly 2/3 of the world's cocoa production. And so certainly when there's a slowdown in cocoa production, that will affect your input prices at a company like Hershey's, and it'll affect margins and all. But I think that's what investors are looking at. You have a 50-year high for cocoa prices. You have to go back nearly to 1977 to see prices this high. Now, do I think prices will remain this high? Probably not. It doesn't last for a very long time. Generally speaking, if you look back over history, prices at this level don't tend to stay elevated. But needless to say, this is from a global deficit due to diseases and heavy rains and all that. And so seasonally, this might last longer than maybe it has in the past. And so we can't say suddenly this will come down, but I think it is a safe bet to assume that eventually cocoa prices will come down, whether that's in 6 months, a year, 2 years. And so over time, your cocoa prices will not remain this elevated. And with cocoa prices remaining that high, the earnings growth over at Hershey's is expected to actually decline in the upcoming Q4, which is the current quarter we're in. And then over the next basically 1 year, earnings growth is expected to stay roughly flat to modestly up, maybe a couple percentage points. And I think these cocoa prices will certainly hamper earnings growth over at Hershey's. Now, the market is always forward looking. And so this 30% decline in the stock price, has that already been priced in? And we can kind of see that from its price to earnings on a gap basis. This is the trailing 12 months, a 10-year chart for Hershey's price to earnings, generally trades closer to a 24, 25 times. I would say that's its median price to earnings. I don't know where this chart disappeared. Historically, I would say its average is closer to 25 times, but you see on a more recent basis, on a price to earnings from a gap perspective, the price to earnings has fallen underneath 20 times. And so really anytime it's come down to this level in the past, back in 2018, and then again in 2020, those have been buying opportunities for Hershey's. And again, it's coming down underneath 20 times a price to earnings. So from a price to earnings perspective, this one looks like it has come down and the market has priced in this slow earnings growth over the next basically 4 to 5 quarters. And then the market has also looked like it's priced in the soaring cocoa rates. And so now the question is the rising price of cocoa reflected in their statement of income? And I think actually not, or at least that Hershey's is able to pass along those higher cost inputs to their consumers. You see key margins having gross margins being up on a year-over-year basis. This is from their last quarterly earnings back in October. And you see gross margins went up to 44.9%, up from 40.6% same time last year. Same with your operating margins, those went up. And then your net margins came in at 17.1%. Last year, we were at 14.6%. So across the board, margins are expanding over at Hershey's, even though the price of cocoa, which is their number one input, is skyrocketing. And so this can mean a few things. Firstly, that Hershey's can go up on price. They have pricing power on their consumers and they can go up on price, at least marginally, to reduce the higher input cost. Secondly, they can offset the higher input costs by maybe more automation or controlling their cost of sales. They did a fantastic job controlling cost of sales in terms of top line revenue growth. You see top line growth was at nearly 11%, and then your cost of sales rising just $50 million. And so your gross profits went up roughly in line with your net sales. And so right there, that is pricing power or the ability to control costs using more automation and offset those higher input costs. Lastly, you could also just have some delay where the higher input cost of cocoa doesn't actually get reflected in Hershey's business, maybe 12 to 16 months after the costs have gone up. And that is probably why analysts over on Wall Street are expecting this company to basically have flat earnings growth on a year-over-year basis next year. And so you can likely see these impacts from higher cocoa prices being reflected into their business over the next 2 to 4 quarters, I would say. Now, from a balance sheet perspective, this is where this company really does struggle. It has nearly $500 million worth of cash and cash equivalents, total current assets coming in at over $3.1 billion. They do have a ton of liabilities, long-term debt on their balance sheet, nearly $4.1 billion of long-term debt, another $800 million worth of short-term debt. So all in all, debt coming in at nearly $5 billion, and they have roughly $500 million in cash and cash equivalents. Not a great cash to debt ratio from a balance sheet perspective. They do have a lot of debt. They still have more current assets than current liabilities, but again, not a great balance sheet just from the fact that they have nearly 10 times worth of debt sitting on the balance sheet compared to cash. Now, its historic 5-year growth rate for Hershey's on that revenue side has been roughly 7%, and then on the earnings side, just a shade higher, close to 9.3%. For 2024, analysts are expecting just over $10 in EPS for the full year. That would bring their net income at just a shade over $2 billion again for the full year. Now, for the next 5 years, I'm expecting earnings growth to compound at roughly 5%. I know there's a slowdown expected for the next year, but then following that, there is expected to be another pick back up. I think roughly 5% earnings growth rate is probably a bit more conservative, but you never know with cocoa prices soaring this much, how long they'll stay elevated for. I'll say 5% compounded growth rate on that earnings side for the next 5 years, taking a 20 times price to earnings multiple. Look, we took a look at its valuation, and from a valuation perspective, 20 times you would say is probably a bit low. But again, they're not growing earnings at the same rate that they have in the past. And so that would certainly demand some multiple compression. Now, the other thing is they do have a decent amount of market share, and they're, again, continuing to grow in that market share. And so 20 times, I'd say, for the next 5 years is still relatively a bit high. But as we saw, this company does have great margins. I'd say better margins than its competitors in the same sector. And so for that reason, I think 20 times a price to earnings multiple, probably a bit on the higher end, but I think can be justified for the next 5 years. You have roughly 204 million shares outstanding. They are buying back roughly 0.5% of shares every year. And so I included negative 0.5% share dilution. You get, again, that 2.59% yield. And so that can bring our discount rate down from 12% down to 9.4%, we apply a 10% margin of safety and we get to a fair value at just over $150 a share. That would be still another 18% decline from the current price of $184. So not a huge ways away from the current price, but keep in mind another 18% decline is significant for a company that has already declined close to 30%. Again, keep in mind those were my estimates of roughly 5 to 6% growth on that bottom line, and then applying a 20 times price to earnings multiple gives me a fair value somewhere between $150 to $160 a share. If you expect maybe a faster growth rate closer to 8%, applying a 20 times multiple, that gives you closer to $173 on your price target. And then if you think my price to earnings multiple was a bit too aggressive, applying an 18 times multiple on that same 6% growth rate, your fair value is closer to $142 per share. So again, keep in mind, these are your estimates based on where you think this company should trade at. Needless to say, I think that $150 a share range seems to be pretty fair, in my opinion, for this company based on their expected growth rates for the next 5 years. Now, this company has seen nearly 7 consecutive months of declining share price, and for this company, that is actually pretty rare. We stretch it back over the last really decade and a half, and you haven't seen 7 consecutive months of red candles. Every candle on this chart represents a month, and you have this string of 7 consecutive red candles. Now, on a 1 year basis, we bring the timeline a bit closer. This has been making a consecutive pattern of lower highs and lower lows. It is once again retesting that trend line at $184 per share. You also have a level of resistance at $184 per share. Back in the past, this acted as a level of support. And so now this will naturally act as a certain level of resistance. So meeting basically 2 levels of resistance at $184 per share. From a technical perspective, you can kind of go one of 2 ways. Either you can see this as it being very oversold, and probably from a relative strength index, this is likely oversold. But again, from a technical perspective, you can see this as essentially a falling knife that's stuck in this pattern of lower highs and lower lows. In terms of a technical breakout, I would like to see this one come up closer to, you can call it $200 a share, really up to $195 a share, before then probably getting rejected, coming back to retest this resistance, which would then act as a support, and then continuing to make a move higher from there. So that is from a technical perspective where I would look to pick up shares of Hershey's. I want to see it break out of this lower highs and lower lows in order to confirm that technical breakout. This one will likely probably maybe even trade sideways until earnings, which come up on Feb 1st of next year. And so that is probably where this stock will likely go up or down substantially, in my opinion. Until then, you can maybe expect this one to trade sideways. Me personally, what I would do with this stock is, if I do come in here and pick up this on a retest at $184 a share, I would set a pretty tight stop loss, basically at $179, $180 a share, because if it comes back and breaks through this level, it would pretty much confirm a re-entry back into this pattern of lower highs and lower lows. And so there I would set a pretty tight stop loss. You have basically a $5 downside, and then your upside is likely back up to maybe $214, $215 a share. And so from a risk reward, not the best, but certainly not terrible. I think you could play it from a risk reward. Again, you would have to set a pretty tight stop loss to make sure this does not come in here and break this resistance and head back into this pattern of lower highs and lower lows. From this sector, it's basically a similar performance. You can pull up a chart of General Mills, has basically made a pretty similar downtrending pattern. You see over the past few months has consolidated sideways, but again, these are companies that are basically competitors. You take a look at Unilever, we took a look at their product map, and all these companies basically compete in the same space. Our consumer staples, my pick for 2024 is PepsiCo. I do tend to like PepsiCo more from just an earnings growth, a buyback, and a dividend safety perspective. But again, I think Hershey's can make a lot of sense. You would want to see that technical reversal, and then again, you would want to keep an eye on these cocoa prices. I'm guessing these won't stay this elevated for a very long time, but until they come down, I think this company will continue to see a struggle on their bottom line and continue to see basically minimal to no growth on that earnings side. That was my take on the Hershey's Company. Let me know your thoughts on this one in the comments section below. Not a company I've taken a look at in the past before, but I will keep this one on my watch list and see if it comes down closer to $150 a share. I think from that perspective, it'll make a lot of sense. And then I'll again keep an eye on this from a technical perspective to maybe see a reversal prior to their earnings release in Feb. With that being said, happy holidays, have a happy and safe new year. We're basically just about a month away from earnings season ramping back up. We'll be back on this channel having videos covering all of the major earnings and a lot more. Thanks so much for watching, and I'll catch you guys in the next video.